don't invest in a company you hate someone mentioned on TikTok. It is the easiest way to lose money very quickly. For investors, I would also say, don't YOLO into one asset.
Yes.
You want to invest in companies that have very decent balance sheets, very decent cash flow, very companies that are moderately valued. They have a global appeal.
And you can recognize their products.
Yes, because when push comes to shove, when shit hits the fan, these are the companies that will survive.
Hi there, welcome to Clockwise. My name is Providence. Today we'll be discussing 5 US stocks you can actually invest in. 5 US stocks you can invest in. You see, these stocks are stocks that we think will do very well in the US market. And you can invest from anywhere, whether in America, from the Caribbean, in Africa, wherever you are, you can invest in these stocks. Now, we'll not just list the stocks. We are going to show you why we feel this will be the best stocks you can invest in, and also how to do your own personal research to ensure that you are investing right. And as usual, I will not be doing this alone. I have my guest, my in-house guest, who is not just a stockbroker, he's also a stock market researcher. And we'll be doing this discussion today. Now, without further ado, with a resounding virtual round of applause, please welcome Mr. Kaneb. Welcome to Clockwise again.
Thank you very much for having me again.
It's a very strong
Thank you
one.
to the
It's
audience.
a very strong one we had last week, and there were a lot of feedbacks. And one of those notable feedbacks is if actually the stock market is more of knowledge or more of patience. For you to succeed in the stock market, do you need to be a knowledgeable person, or you have to be a patient person?
So it's a combination of both. You have to be knowledgeable, you have to be patient, and here is the reason. First of all, you have to know exactly what you're buying in the stock market, well, in the financial market. So you cannot buy something, a hype. You can't buy something that has no value whatsoever. Because you just hit you saw something on someone recommending it on TikTok.
Yeah.
You buy it when, in fact, it's been hyped up to the top. You are most likely going to ride it to the bottom.
Okay.
So it's the first thing, you have to buy an asset that you know.
You've done your personal research.
You've done your personal research. You've consulted materials. You've listened. If it's a company stock, you've looked at their earnings, fundamentals, their earnings score. You've been part of you've looked at the earnings guidance. That would actually help you to make the right decision.
Because what are you waiting for? Are you waiting for what you don't know?
You can't wait for what you don't know, of course.
Yeah.
So beyond knowing what to buy, the next thing is that you have to be patient. Market is in cycles. Sometimes you can buy the market, buy the highs of a market. The only thing, like they say, if you are patient, that's why they say time in the market will always beat timing the market. I don't advise anybody to try to time the market. Rather, I would tell you to allow time to work itself out. You invest. If you are afraid that you might buy the top, why don't you do what we call the dollar cost averaging? Meaning you allocate a certain amount of money
Every month.
It might be every month, it might be every week.
Anytime, okay.
But at regular intervals, you allocate a certain amount
A
of
fixed
money.
amount of money.
Yes, to a particular asset or a group of assets. Yes, you could also have some dry powder. You could take advantage of very serious market dislocations.
Okay.
But as a rule of thumb, you want to have that dollar cost averaging as what you would be looking at. That allows you to even
grow.
out your entry, because what you mean by profit or what you mean by upside in any stock is actually what you make what the appreciation based on your entry. So you want to dollar cost averaging allows you to have a smooth entry. You avoid all the bumps in price action and all of that. So that's that. Then, but you have to be patient. So
if you have to rate them, it's knowledge first, then patience.
It is knowledge and supported by patience.
Because
if you pick either, you are not going to be successful. If you pick knowledge, if you pick patience without knowledge, that's a wreck. If you pick knowledge but without patience, you are most likely going to sell the bottom and buy the top. So that is exactly why we advise trader. And then another thing is, you must have a time horizon for your investment. You must, if you are going to invest for maybe 1 year, there are some assets that you can invest in 1 year. There are some assets you could do for
1 month.
let's leave all those 1 month. We are not doing gambling here. There are some assets you can do for maybe 5 years,
Because
10
somebody
years.
asked me, can I buy asset for 6 months and I will make so much profit?
That's why I'm saying there are Ponzi schemes available that you can actually do that. We want to believe that people that want to invest are serious. Investment is a serious business.
It's a long-term business.
You are literally exchanging your value. You've exchanged your time for cash, for money, and you need that money to make more money for you. So it's not something you go to gamble. If you want to gamble, you know where to do that. But here we're talking about investing. When we're talking about investing, you have to give it time. You have to have a time horizon. For example, if you are doing, let me use crypto again. If you are doing crypto, for instance, then it's always advised you have a minimum of 4 years or 5 years in terms of the time horizon for that investment, because experience has shown that if you, in 4 years, in the space of 4 or 5 years, no matter where you bought like Bitcoin, you will always be back into profit.
Okay, yeah.
That's just a reality.
Yeah, that's the truth.
So you have to give a time horizon for your investment, and that's where you can win.
All right, now talking about time, before we actually start listing those 5 US stocks, I want you to make a clarification about what the difference between the stock market and the forex market. You see, most people are really confused. They actually come into the stock market with the forex ideas. That's why I asked you at first 1 month, and you said no, because people have asked these questions. Can I buy stock and I'll be yielding profit like every month or every week? Now, differentiate between the stock market and the forex market. What actually differentiate the both of them?
Okay, the stock market is where you buy tiny parts of companies. Companies
that are known.
The companies that are known, companies that have been listed in the public market. While the forex market is where you trade currencies. We assets. Not assets, currencies specifically. Foreign exchange market, that is forex market, is where you buy and trade for currencies. So you can trade the US dollar. They are always listed in pairs. For example, Euro USD would be if you are buying Euro USD, actually you are literally buying your euro and selling the dollar. That means you believe that the euro will appreciate against the dollar. You know, if you are buying, for example, like a pound dollar, that means you are buying the pound and selling the dollar. That means you believe that the pound would appreciate. Essentially, that means, because when you are buying a currency, actually you're buying into the economy of that country. So if I'm buying the euro and selling the dollar, that means I believe that the European economy will perform better than the US economy. And then if I'm selling that position, if I'm selling a Euro USD position, that means I'm betting on the fact that the US dollar will outperform the euro. So that is the forex market. Now, there are different ways that people engage in the forex market. Sometimes, in fact, for the most part, especially for retail investors, they use what we call leverage. And that is one of the things that allows, what does leverage do? Leverage is like, I have $1,000, but I want to buy one standard lot. One standard lot is $100,000. So, I can put up that $1,000 as, like, let me use a very common word, collateral, to get $100,000. That means I'm trading on a 100 to 1 leverage. So that means I can now open a position size worth $100, which is $100,000, which is standard lot. So that allows me to take on more risk, or to get a more upside, but take on more risk, because it's like a double-edged sword. If it goes in my favor, I get to make more than what I would have made if I just had a $1,000 exposure. But if it goes the other way around, it's also the same thing. So
basically, you're trading currencies.
Yes, trading currencies. So it's important that if you are coming into the financial market, you should understand, are you trading on leverage? If you are trading on leverage, then you should understand some of the risk involved. Your stop loss you must be very certain about your stop losses, your take profits, and all of those things. There are a bunch of that. I don't want to dwell so much into that. Then in the stock market is where you literally buy the parts of the companies, and then you hope that these companies will do well. If they do well, then you make profit. Most brokers don't allow leverage on stock. No. So if I'm buying $1,000, I'm literally buying $1,000 worth of stock.
Okay.
So, but what that means is that the advantage is in regarding the forex market. If the market hits your stop loss or you are liquidated, your position is gone. But in the stock market, if you just bought, let's say, 1,000 units of a company, and no matter how much it goes down, you still have 1,000 units of that company.
Yeah.
If it goes to zero, then you have 1,000 units of the company. So what that means is that if the company, maybe there's a turnaround, the company goes back up, so that means your position is still there. Sometimes you can even make more. Eventually, you can make more than you invested in.
Okay.
So those are the differences between using leverage, which is many people use in the forex market, and using your own money, which is what applies especially in the stock market.
All right. Now, before you list the companies, the 5 US stocks. Now, give us an overview of how the US stock market is currently. Just a general overview.
Okay, so the US stock market is basically controlled by a number of things. Currently, we are in a bull market. We are in the 4th year of a bull market. We had the first bull market in 2023. The S&P 500 returned 24%. In 2024, we continued another very strong bull market. The S&P 500 returned 23%. Last year, which was 2025, we also still continued, though we had a bear market earlier in the year. In April, I think the market bottomed out on the 7th of April. So we had what we can call a bear market within a bull market. S&P 500 actually went down to, in fact, it eroded the gains, almost an entire year gain. It went down to $4,800, which was the previous year's close.
For the sake of those who are just following us, S&P 500 is the 500
is the 500 top companies in the US. Yes. So the S&P 500 actually eroded literally an entire year's gain. So that for us was a bear market within a bull market. But again, which is one of the things I talk about, allowing time. The market still ramped up, back up, and closed the year at 19% performance. So that still made the year a bull market. This year, the market we are believing it's going to be it's the 4th year of the bull market, and the S&P 500 has started off on a good note. But there's something that controls the market, which I want most of anybody that is listening or watching this podcast to understand. There are some things that control the market. Number one, the Fed policy. Because the Fed policy actually determines what happens, most especially in the bond market. Now, interest rates. So the Fed actually has two mandates. Number one, to ensure that inflation is tamed. Inflation expectations are well anchored. That's number one. Number two, to ensure maximum employment. So when inflation seems to tick up, the Fed uses its monetary tool, which is the Fed's funds rate, to tame the market. Meaning, if inflation is tipping up, what does the Fed do? The Fed does what increases the federal funds rate, just to make borrowing costs to be more expensive. That way, people spend less, and that tames the inflation. So it's what we call the demand side of inflation. That's what the Fed does. And then at the same time, if the unemployment is high or inflation is low, then the Fed, remember they have a dual mandate. The Fed can move from focusing so much on inflation, like what is happening around now, or late last year and around now. The Fed moves over to focus on employment. Meaning, if employment takes up, let's say, to 4.6, 4.7, that's like an indication that the Fed should wade into the situation. What would happen there is that the Fed would lower interest rate, meaning making funds cheaper for people, for companies to borrow more. When companies are able to borrow more, they can expand and hire more people. Okay, so those are the two things that the Fed, and these things control the markets, because when the federal funds rate, typically when the federal funds rate is up, what happens in there is that the bond market, the 10-year could go to above 4.5%.
Okay.
And what that means is that, remember, I told you in the last episode that the bond market determines what happens in every other market.
Okay.
If at a 4.5%, I mean, investors will feel more comfortable parking their funds in the bond market, rather than going to the risky market like equity markets, crypto, and all of that.
Okay.
So whatever happens in the bond market, if the Fed funds rate tick up, that means the bond yields go higher, meaning that the bond market becomes more attractive to investors. Investors will park cash there. But when the federal funds rate goes down, like, I mean, over the past several FOMC meetings, a couple of FOMC meetings, we've had the Fed lower interest rates. Now, when the Fed lowers interest rate, what happens? The other, like, the bond market, the bond markets, the interest rate on the bonds go down. That means it presents a less attractive outlook for the market, and with that, investors are most likely going to do what? Look for where they can get higher returns, which could be the equity markets. So you have to look at what the federal funds rate is saying. For example, yesterday you saw what happened to the S&P 500. The jobs data came out. Unemployment is down to 4.3% from what the market was actually predicting 4.4%, but we had 4.3%. The jobs numbers also show that we added I think 130,000 jobs, which means the labor market is still strong. Investors have been looking at the impact of AI on the job market, but something seems to be happening. Remember, because of the government's policy on immigration, that has stemmed unemployment. So you look at things like the job job openings and labor turnover. Those numbers actually influence what the Fed's perception when it comes to the job market. So you look at the job market, you look at the CPI, that is the Consumer Price Index. These are the two numbers. Although the Fed works with the PCE really, because that strips energy and food. But let me use the word inflation. So inflation and the jobs numbers actually determine what the Fed does, and whatever the Fed does influences what the performance of the stock market.
I want you to first of all list those 5 stocks. List them first. Then you not tell us why. You tell us how the process of you actually arriving at these 5 stocks.
Okay, so I mean, the theme for this year for me, it's actually AI. Of course, we have seen a number of things that AI has literally done so much,
and AI companies are doing.
And AI companies are doing so much. So I'm looking at the infrastructure. I'm looking at AI infrastructure as well as hyperscalers.
Okay.
And I'm going to explain what I mean by
data. What of power, electricity?
So yeah, so that's the point. So I'll get there. So now the first one I will be looking at, of course, this year would be Nvidia. Yeah, Nvidia is over $5 trillion, but look at it. Nvidia is the biggest name when it comes to chip manufacturing. And when you talk about AI relies on chips, on compute. You know, the Jensen Huang, the president and CEO of Nvidia, said something in the last earnings call. Well, of course, in the next 3 weeks, we expect the last quarter Q4 2025 earnings from Nvidia. But Jensen Huang has always said, in fact, said a couple of weeks ago, that the demand for Blackwell is one of their latest insanely powerful chip, is off the charts, because companies are looking for these chips. Hyperscalers, most especially, are looking for these chips to power their data centers, to power their data centers, and AI compute rely heavily on chips. So if there's anybody that is going to win so much when it comes to AI, the AI run is Nvidia. And then Nvidia, not just that, Nvidia also invests across board. Nvidia invests they have a very big investment in OpenAI. XAI. Most of the big names in the AI space, Nvidia, so they are like literally spreading the risk, and they are building a moat around. Nvidia has an ecosystem when it comes to training, inferencing, chips, you name it, they have it. So they have that moat allows them to be very, 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 very competitive. Nvidia makes more than 80% of the chips used in computing and AI workloads.
Those are very strong companies.
So that's a very huge one. And Nvidia is trading at 27 times earnings, which is very, very cheap as far as I'm concerned. If you look at the likes of Walmart and Costco, these are guys are trading at over 30 times earnings. Some, and even more. So Nvidia is still relatively cheap, if you ask me.
Okay.
So Nvidia is one.
Number two.
The other one I would also want to look at is Microsoft. Now I'm going to hyperscalers now. Microsoft is ticker symbol MSFT. Nvidia is NVDA. I'm just saying this so that when you are looking up, you will know exactly the company we're talking about. So in Microsoft, when you talk about not just Windows, you talk about productivity, Office, you talk about cloud computing, which is very key for their AI program. You're talking about Azure. These three are big when it comes to competitiveness in the age of AI. So Microsoft, because a number of companies that actually need resources for their need computing for their AI infrastructure will rely so much on this cloud computing infrastructure, which Microsoft's Azure provides. Okay. So Microsoft is such a behemoth when it comes to that. And another thing is that remember that Microsoft has a very big stake in OpenAI. As a matter of fact, they were one of the biggest investors in OpenAI. OpenAI is now planning to go public this year. Analysts are touting, I think, $1 trillion in valuation at the IPO. So, OpenAI is extremely competitive when it comes to large language model, when it comes to generative AI itself. So, success for OpenAI means insane success for Microsoft. Okay, so that's the second one. Okay. The next one, Nvidia, Microsoft. The next one I would want to talk about is Alphabet. Of course, you can't talk about with the performance that Alphabet did last year. Gemini moved to become Gemini was the fastest growing LLM in terms of adoption.
Yes, large language model.
Yes, in terms of adoption last year. So, but I don't want you to look at just when it comes to AI. You're talking about Gemini. Gemini is very competitive. As in fact, when you look at
than cloud,
they are more competitive. They are almost more competitive than OpenAI's ChatGPT. Gemini. So when you look at Gemini, was in terms of growth, it outpaced ChatGPT last year. Yes, and it's most likely going to repeat the same thing this year. But beyond, I want you to understand that Google has a moat. Remember, Google is the king when it comes to
data.
When it comes to search, when it comes to video, YouTube, when it comes to Chrome is Google's proprietary browser, and Gmail. So guess what Google is doing? Google is actually integrating Gemini across all of this, making Gemini to become such a household name, bringing so much adoption to Gemini. So that we call that distribution, that massive distribution capacity of
because
Google.
Of the number of platforms.
Yeah, the platforms they can actually distribute Gemini to, makes them so competitive when it comes to AI. Now, don't forget also that Google is also a hyperscaler, because you have Google Cloud that also provides AI compute. So in terms of AI compute, in terms of search, in terms of video, in terms of Google is very competitive. So we expect it to do very well this year.
So that's number 3.
That's number 3. Number 4 is Amazon.
Okay.
Amazon did a very sterling performance. It was like the comeback hit for last year, which also goes to tell you why I say don't try to exit the market prematurely. Yes, patience, very important in the market. Amazon is a, of course, Amazon Web Services provides an insane capacity when it comes to AI compute. So Amazon itself is a hyperscaler. So they provide AI compute, and if AI is going to be successful, a successful theme this year, which I believe it will, then we are looking at Amazon as a very serious contender. Amazon also has.
Would they be actually porting it to AI too? Amazon.
Amazon is building an in-house AI infrastructure, but here is the deal.
Will you be spontaneity?
Amazon. I want you to consider that Amazon is the largest. When it comes to hyperscalers, people providing AI compute, Amazon is the largest. However you look at it, Amazon benefits so much. A lot of companies, a lot of institutions that are building they are looking for AI compute capacity are looking to Amazon for that. So Amazon is really, really competitive when it comes to AI compute. And if AI is going to win this year, which I believe they will, AI will win this year, Amazon is the name to look at. And the valuation of these companies are very, very reasonable if you look at it. In terms of the PE ratios and all of that, they are very, very reasonable. Then, of course, Amazon is ticker symbol AMZN.
Yeah.
Then the last one, which is the fifth one I will mention, is a very, very, is a name that before now I didn't really consider these guys, but I mean, in the era of AI, these guys are a big name now, which is Broadcom. AVGO, yeah, Broadcom. It's a chip manufacturer, just like Nvidia. They're like close pals with Nvidia.
Okay.
So when it comes to AI compute chips, in terms of chips or AI compute, you have Nvidia, you have AMD, you have Broadcom. But Broadcom seems to be very, very competitive because of their focus on AI chips and all of that. So Broadcom the valuation is very, very, is relatively cheap if you ask me. And then is also a very force to contend with when it comes to AI or compute chips that are required for AI compute. And the demand, they have a very, very long runway. When I mean by long runway is what I mean is this: the demand, how long can the demand be sustained in terms of the deliveries? Let us say you have if you have 3 years of demand to feed, that's a very good runway for a company. So Broadcom has a long runway. So in the era of AI, I am very certain that Broadcom is going to be very, very successful.
Okay.
And Broadcom is not expensive, if you ask me. So I think Broadcom is a name that you should be looking at. Okay. In all of these,
so let's list it again.
So we have, the first one is Nvidia. The second one would be Microsoft. Sorry, Nvidia, ticker symbol NVDA. Second is Microsoft, ticker symbol MSFT. Then you have the next one is Alphabet, ticker symbol GOOGL. Then you have Amazon, ticker symbol AMZN. Then you have Broadcom, ticker symbol AVGO.
Okay.
Then these are the 5 stocks. Of all of these, you can see that I've mentioned 3 of them are hyperscalers. You have Amazon, you have Microsoft, and you have Alphabet. Then you have chip makers, you have Nvidia, and then you have Broadcom. I know some people will ask me, names like Tesla, names like
what of Tesla?
Names like Tesla and all of those. Yeah, Tesla is also a force to contend with. But when it comes Tesla, we should understand something. Tesla in itself is trading at an insanely high PE ratio. Price to earnings ratio. That's what I mean. I mean, at this point, people in this channel should be able to know some of these acronyms. So Tesla is trading at such a high ratio, and the Tesla could be, if I had to mention maybe up to 10, I would have included Tesla, because you can see that I'm not mentioning a lot of them. I've left some Mark 7. There's companies that we call the Mark 7. I've left a couple of them out, and the reason is because we have seen what has happened with tech stocks. what has happened with tech stocks would be that AI has come in to do a lot of work. To be honest with you, but for me, I still consider the sell-off in tech stock as a buying opportunity.
Okay.
And the reason is that some of these companies have very, very, very large, humongous, in fact, mountain of cash flow, which means that the likes of like Apple has not done spectacularly well when it comes to AI, but we still believe that they are going to do something.
Because
I've not mentioned
Apple can come back.
That's what I'm saying. Apple can come back. I've not mentioned, for example, Meta. Meta is doing some, but if you've seen that some of these tech names have actually had a very serious sell-off, and that's because of the productivity, the insane productivity that AI has done. I mean, today you can literally, build an app with a few lines of prompts. So this is like investors are beginning to look at tech stocks as being threatened. But the fact is, if you look at it from the from the longer perspective, and also understand that most of these guys have such huge cash pile on their balance sheet that they can actually use to pivot or to branch into AI, then you would know that these are very, very good buys. So I consider this as buying opportunities. But for those 5 names I've mentioned, those guys are the people that I know will win.
Okay.
I know that AI is going to be a winning theme this year, and those names are the names that are going to win.
The AI bubble continues.
Don't call it bubble, because when you say bubble, people think it will pop. So I don't want to. Even if it's a bubble,
but even if
it's a bubble, look, here is the deal, and I remember the last time I had a conversation with you, you asked me, are we looking at the repeat of 2000, the dot-com bubble? Here is the difference. The dot-com bubble had companies that had nothing when it comes. Some of these companies did not even have a business, no product, no business case. Some of them had nothing. There was no path to profitability. They were not even having any revenue whatsoever. But this one, you have names. Some of these AI names are names that are minting cash. These guys are printing money. Okay, for example, Nvidia is making over $100 billion per year in terms of revenue. That's an insane amount of money. And that's why if you look at the earnings, how much they are trading, Nvidia is 27 times earnings. Most of this, okay, let me give you an example. When the dot-com bubble busted in the 2000s, a name like Cisco was trading at over 230 times earnings. Yes, Nvidia is just 27 times earnings. So what makes you think that Nvidia's bubble is about to burst? Look at the AI companies that we have. A lot of them are between 20 at most maybe 30. I'm not talking about the likes of Tesla. Tesla is an exceptional case. It's about trading at about over 300 times forward earnings. But most of the AI companies are trading at some 20, some 27, some 30, within that figure. So that doesn't sound to me like a bubble that's about to burst. So if you ask me, I believe that the AI run is going to...
Even the dot-com AI that actually busted,
dot-com bubble.
Yeah,
they don't end.
The era of dot-com.
But watch this. I think that bubble bust actually bring out the names. Amazon was there. Of course, Amazon did a 90% correction. Yes. But it still survived. So that's why I tell you, look at names. Yesterday, someone called me. After watching the video that we did the last time, he called me. He said he wants to invest in penny stocks. And I told him, listen, you might decide to go the route of penny stocks, yes, but I believe that. And he said, you did not mention. I watched the video. You did not say anything about penny stocks. I said, listen, you want to invest in companies that have very decent balance sheets, very decent cash flow, very companies that are moderately valued. They have a global appeal.
And you can recognize their products.
Yes, because when push comes to shove, when shit hits the fan, these are the companies that will survive. Amazon was still part of the dot-com bubble. but Amazon survived.
Yeah, till today.
So eBay was part of it, in case you don't know. Survived. So those names that had real products, that had a global appeal, that had something, that had a path to profitability, survived that bubble, that bubble burst. So for me, I would want people to really look at this as you are betting on a company that has a decent moat, cash flow is good, leadership, balance sheet, and of course that is not very much, that doesn't have so much macroeconomic headwinds against it. I mentioned macroeconomic headwinds because sometimes you could do all of these things and then something could come out, maybe a government policy could come out and then target you squarely and everything is gone. So for investors, I would also say don't YOLO into one asset.
Yes.
I know some investors that will pick everything. Like the guy told me he wants to buy 1 million shares of one stock. I said no, that's not the way to go. Rather, except you are going for a competition, you want to have a bragging right that do you know I have 1 million shares of a particular asset. No, rather we always talk about being diversified. You could be looking at things like, yeah, of course we are still in a bull market, but you can still do some apart from these growth stocks that we've been talking about, because all the names we're mentioning are growth stocks. We also want you to consider
even
dividend stock portfolio stocks. You also consider what we call defensive stocks. The reason is because if something happens, let's say we get another Truth Social post, from that will not ruin your portfolio. Imagine what happened last year when during the tariff debacle. Some people saw their stock go down by more than 60%, especially for those people that were into some of those growth names. So if you had a diversified, balanced portfolio, what that means is that you would have at least some shock absorbers to ensure that you are not emotional. Because what makes us to be emotional sometimes is when we see our portfolio have a sharp correction. But if you have balanced it with some defensives,
dividend
paying and some defensives, what that means is that the shock is balanced. So let's say instead of having like 40% correction, you're having something like maybe 15, 17, 18%, which is better to deal with.
Okay, now before we go, the last question before we go. Now, I'd like you to actually give us break down the processes of actually doing, should I say, research on these companies, so that these people, our viewers, can also have the time to undergo their own research, to actually carry out their own research on these individual companies.
Okay, let me say this. The reality is, AI, you can actually use AI to do most of this research, but you have to know how to prompt the AI to do the research. Without making any advocacy, I'm supporting. This is not sponsored though. Without supporting any name, I want to say that Perplexity does a very good job. Yes, Perplexity does a very good job in terms of, because number one, you want to look at, I had talked about the fact that you want to know, is a company overvalued? You look at, and how do you see this? You look at the price to earnings ratio. You look at the market cap. You look at the cash flow.
Okay.
You look at, there are some things, you can look at the balance sheet. I mean, at this point, you see, the fact is, you don't need to be a stockbroker.
Okay.
I know I'm going to say this and you say, that means you are trying to. No, it's the reality. AI has made it very simple. Do you know that you can actually upload the balance sheet of a company, the company's annual report? Just put it there. Put a few information you have and AI will make a very good recommendation whether it's a company, can give you some projections, whether the company is something you can actually bet on. Okay. So you can use AI to do this, but you have to be very careful too. AI can make mistakes. Okay, you cannot rely 100% on what an AI tells you to do. You can reach out. You can reach out to a stockbroker. You can reach out to.
You can even put your questions on the comment section.
You can actually put your question on the comment section, of course.
We're going to respond to it.
You can reach out to an investment analyst. I happen to work an analyst for a private management firm, wealth management firm. So you could if you choose to go that route, you could decide what you gain from here is that you have a balanced insight on how to invest. Don't invest in a company you hate someone mentioned on TikTok. It is the easiest way to lose money very quickly. Don't invest in Ponzi scheme. Someone is telling you we do 20% per year. Someone asked me yesterday, came to my office and asked me how much if I invest in this in your wealth management firm, how much do you look to pay per year? I said there's nothing like that. Most firms, most wealth management firm, most hedge funds, whether it's a hedge fund, whether it's a private investment firm, most of them operate the formula, what we call the 2 and 20 principle. So let's say you invest $100,000. There's the 2% there is what we call the management fee. So they will take out the 2% management fee, and then they invest what is left, the remaining 98,000. But the hurdle rate is 100,000, meaning what they call profit on that investment is anything above 100,000. So if that money makes, let's say, 20,000, you at the end of the investment year cycle or the year, you have 120,000 for that particular portfolio. That means the profit is $20,000, and then based on the 2 and 20 principle, that means the management firm retains 20% of whatever they make. So what that means is that for that $20,000, that is the profit, the management firm keeps $4,000 and gives the investor $16,000. Nobody can tell you I am going to make so. Anybody that tells you I'm going to make so and amount this, except of course they are looking to invest in maybe a fixed income asset,
like bonds,
But when it comes to investing in the broad market, you can never tell exactly. It's not predictable. A lot of people actually predict. For example, in 2023, because we just came from the October, everybody say we are going back to the 2022 October lows. The likes of one of my someone I like, I admire a lot, Tom Lee of Fundstrat Global Advisors, said the market would actually close way higher. In fact, he called the end of year target very accurately, and the market returned 24% against the downdraft that a lot of investors thought. So you cannot exactly tell what the market would be. All you want to look out is ensure that you invest, you are so diversified that no matter what happens, you are not so wrecked, at the end of the day. Yeah, and that is by growth stocks, dividend stocks, defensive stocks. And then you can also invest in broad market index like the S&P 500. I'm talking about the US market now. S&P 500, the Dow Jones Industrial Average, and of course the Nasdaq. These guys have done insane numbers in the past 3 years, and we believe they will do the same thing this year.
It has been a very swell one with you. Honestly, I've learned so much. Thank you for coming again.
Thank you. You're welcome.
You're welcome. Yeah, that's been our package for today. And if you have any question, you have anything you want to say, what you want to say, just drop it on the comment section and we'll respond to it. Now, next episode, we'll be talking about the step-by-step. We'll show you the step-by-step process on how to actually carry out research in the market, how to research the market, how to actually research the market, even if you're not a stock broker. So keep a date with us. And also, do not forget that the illiterate of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence, and my guest was Mr. Ekandem. See you again in the next episode.